What's going on, guys? Today we're talking about SOFI, the official bank of the NBA. I stumbled upon one of the best articles I've seen about SOFI, and that's the main thing we're going to be going through. SOFI is a great company, great management. You can see what they've been doing with the company growing like crazy, and it's even posting some positive earnings, which we love to see. And better than listening to me talk about it, let's read through this article. So the bear cases. So it's whatever the bear cases are for SoFi, it goes through them. It's going to be going through stock-based compensation is too high. SoFi is reliant on their student loan business, and if the moratorium were extended, the company would be end up folding. SoFi isn't profitable and never will be. SoFi has no moat, has a lot of competitors. Let's talk about it. So first off, what do they have here? Do 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 do. SoFi revenue. So this is just the bears commenting, no mode, burning cash, only selling loans, all this, and during the whole time the revenue is just skyrocketing. Current revenue is what? A billion, $2 billion annual revenue, 600 million in the last quarter, market cap of 7 billion, up 5%. And we'll at the end of the video we'll see if it's the right time to buy, and we'll look at some technical analysis. But right now, stock-based compensation. So you have the stock-based compensation, which is about 75 million to 80 million per quarter. 1/3 of that is related to performance share units, which were issued as the part of the IPO, and the performance share unit expenses will roll off in Q1 2024, as the residual portion of that is about 12% of revenue today, and we expect that to go down single digits over the course of the next several years, which makes sense because their revenue is skyrocketing. So the stock-based compensation, if it stays the same, it will have a much less significant impact on the revenue. So if we look at this on the stock-based compensation, the orange, it is 55 million Q1 2024. And if you look at the revenue, it's way up. So the green line represents the percentage of revenue, and it's just going way down, which we love to see. And another thing that I was going through the annual report, and when it came to the stock-based compensation, what did they say? They said good things. And I don't know where those things are. Let's find it. Okay. Stock-based compensation. So why do they even have stock-based compensation? They have it to attract, retain, and motivate their employees, and quote unquote encourage them to act and think like owners, which we really want to see. They have 4,400 employees, and it's hard to keep track of them. And if you give them stock-based compensation, it'll motivate them like crazy. It would me. They have 73% of their employees are in the US and 27% are international. And let's keep going. So the stock-based compensation is not a fear at all, that I don't see being a problem in the company. So the next thing is student loans. If we look over here at this graph, I love how it has graphs. Student loans, the green part is the biggest part of the revenue, but we can see that the home loan originations are growing because SoFi is like one-stop shop for financial services. They have everything from credit cards to home mortgages. So I think that's a huge thing that they're getting into. And clients who have a mortgage with the bank, they'll be paying it off for a long time. So those are sure clients. That is a great market to expand to. So the big three: personal loans, student loans, and home loans. End of 2019, the lending business was firing on all cylinders, and student loans were the leading way, representing 68% of all originations in Q4 2019 and growing at a very fast pace. Then COVID hit March 13, 2020, and CARES Act paused all federal student loan payments and set interest rates to zero, which should crush their whole business for student loans. The student loan refinance business predictably fell off a cliff thereafter. It is now 4 years later, and it still has not recovered, not anywhere near where it used to be, especially when you consider that SoFi has 8 times as many members as they did in Q1 2020. So student loan originations is way down. but they're still around, they're still growing. If anyone have told me in March 2020 that that was about to happen with student loans in the same breath as that SoFi would nevertheless grow at an annualized CAGR of 46% in the next 4 years between 2019 and 2023, I would have laughed them to scorn. Name a single leadership company that executed such an incredible pivot due to external forces in such a narrow window. What they have accomplished is truly mind-boggling. The leadership is just amazing. Okay, revenue from hero products. So hero products is the main product of the company. Tesla would be cars. Tesla's over 80% of revenue comes from cars. SoFi student loans was over 60%. So that he's putting the analogy that if what if Apple could no longer get any revenue from iPhones, which is 50% of their revenue, they would crash dramatically and most likely not recover, which would be an insanely hard thing to do. And it's just stating that just them recovering from that is insane. So it puts a lot more trust into the leadership. Now, next thing is profitability. SoFi is not profitable, is uninvestable because it is wildly unprofitable and burning cash. SoFi management made 25 separate statements in 2023 that they would be gap profitable in Q4 2023. In spite of this, I was told plenty of times by many bears that SoFi would not turn profitable by the end of 2024. Even if they did hit in Q4 2023, it would be one off and they'd go back to unprofitable thereafter. They hit their guide in Q4 2024 and they were profitable again in Q1 2024. Prove it was not just a fluke. They've guided to being profitable every quarter here on out. So now SoFi is a profitable company. And if we look at Q2 2024, they're profitable once again and their earnings grew. One thing I love about SoFi is they always beat earnings. Oh, Q3 2023, they missed earnings. Okay. Well, in most cases, oh, okay. In most cases, they do beat, their guidance is always lower than their actual performance, which we like to see. We want to see them beat the analyst guidance. So if you continue reading, they hit their guide in Q4 2023 and they were profitable again in Q1 2024. We just read that. So that is just a fluke. They are turning profitable. They are profitable, and they're going to continue being profitable from here on out. That's what they said. Rising killing rates, killing growth. True. In the fastest rate hike cycles in history, SoFi would be forced to shift from cheap capital to expensive capital. This will stall growth and hurt margins. The bear argument makes a lot of analytical sense. For example, when they released their savings account in early 2022, they only paid 1% APY for deposits. They now pay 4.6%. Rising rates did in fact cause SoFi's cost of capital to skyrocket. The argument was that rising costs will squeeze net interest margins and kill growth. Bears were right, and their weighted average cost of capital would balloon very quickly, especially in back half of 2022. And we can see that it is skyrocketing up, which is one a catalyst that we could see for SoFi is if the Fed cuts rates, it would be a huge green flag for SoFi because they would have lower cost, they would have cheaper capital once again, which would make them easier to beat competitors by giving better prices for interest rates for loans, and they would make more money off it. It would raise profit margins. What the Bears didn't take into account was that SoFi had a trump card up their sleeve that is unique to them and has not been replicated by their competitors. Member growth leads to a larger pool of possible borrowers, which increases demand for their personal loans. That increased demand that SoFi was able to front run the Federal Reserve's rate hikes. Even as the Fed was hiking rates at an unprecedented speed, SoFi was increasing the interest rates that they were charging to their borrowers at an even faster rate to stay profitable. This is in stark contrast. Competitors like Lending Club saw the interest rates that they could charge on their loans lagged the Fed by 100 BPS according to their own Q3 2022 earnings call. This has led to a collapse. You can see the guy who made this blog has researched their competitors as well. I have not done so yet. This led to a collapse in lending clubs NIM. SOFI's ability to lead Fed rate hikes resulted in SOFI's NIM expanding overall the rate hike cycle rather than contracting compared to what happened in the continuing to happen to lending clubs during the same period. The bear was dismantled by being agile and excellent execution. So green is the lending club, SOFI is blue, net interest margins. Their competitors going down, SOFI going up. That's what we like to see. Banking crisis. An unproven neobank like SOFI would fold like a house of cards during the banking crisis. In March of 2023, several banks folded, and there were ridiculous calls about how SOFI was at risk of a bank run. Silicon Valley Bank was the first to fall on March 10. At that point, over 90% of full SOFI deposits were already insured, so the risk of a bank run was virtually 0%. Awesome. Nevertheless, 8 business days later, on March 22nd, SOFI rolled out a program that increased FDIC insurance coverage to $2 million per account, ensuring their clients, making them feel safe and retaining them on their platform. Increasing the amount of their insured deposits to above 98%. It is still above 98% today. SOFI made a quick, agile change to quell fears and implement the change in less than 2 weeks. The bear was dismantled. By now, you should have been noticing a trend that these guys understand the industry they're in. As I was going through the annual report, they state many times that you need to be adaptive and be quick to change because the markets are changing, the new things are coming out, and you cannot predict the future of the economy. And then they understand that, and that's why they're always changing and always on their toes, ready for whatever happens. SOFI has no moat. The bear case is still up for debate. I think SOFI's moat is small but expanding. I wrote 2 full articles on this. For those who are interested, we can go through this in another video. What I just presented between SOFI and Lending Club is another pretty good argument for expanding moat. We'll leave this as undecided for now. Fair values are wrong because they aren't selling loans. So the bear case for SOFI is inflating the value of its loans by using fair value and counting and juicing their numbers. Declaring complete victory here is still premature, but the balance of evidence, in my opinion, is now thoroughly on the bullish side. After the recent light that has been shown on the bears, it might require a full article to go through this in depth. But I'll cover it briefly here. Between Q4 2022 and Q3 2023, this was the skeptic's favorite talking point. The argument went like this: SOFI was actually inflating the fair values of its loan to juice revenues. The real fair values were much lower than the stated fair values. The evidence for this was that they weren't selling any personal loans. The logic was that they weren't selling them because they could not sell them without taking a massive markdown on their entire portfolio. SOFI management clarified this multiple times. Blah blah blah. I'm getting tired of reading this, guys. Should have had some points. The rubber would meet the road around Q4 2023 and Q1 2024. They got closer to their capital ratio minimums. There we go. SOFI personal loan sales, and so this is where the bears were having a great time. Q2, Q3, and now you can see that the personal loans and securitizations is back up to where it was before. Great recovery. $1.2 billion. Neither of these things, Q4, not only did SOFI sell over $1.2 billion worth of personal loans, the second highest total, we're going to go over the investor presentation a little bit, which we can see the quarterly performances, the new users and whatnot, which is just incredible growth. This is what I'd like to see. Stick around, guys. even higher sales were executed in even higher levels. Management gave definitive statement a year in advance, which they reiterated several times, that the values were justified. They were holding the loans on purpose. The statement, that statement, based on the evidence we have, was truly completed and justified. They were holding the loans on purpose, and they can see that there were interest and demand in the loans. There are still some questions surrounding fair values, discount rates, and loss sharing arguments. But what better justification for the fair value of the loans can you have than over 2.4 billion of actual loans sold to the market in the last 6 months? The bear case has been, the most part, dismantled. Quick addition. If you look at the surrounding rates SOFI uses in the calculation, this was also clarified Q1 2024 earnings call when Chris said, importantly, the benchmark rate change and the spread change are empirical as they are actual market observed inputs, not assumptions. So, spread assumptions, the bear harp on the discount rate that highlight is a red flag or not an assumption that SOFI pulls out of a hat. They're based on empirical market data. The debate for fair values and discount rates has been much more convincing when SOFI wasn't selling loans and didn't have market data to justify the marks. Now that the market data is here, the argument holds considerably less weight. The accusation is that they're cooking the books and lying to investors. There's always going to be a gray area. Obviously, calculating fair values isn't an exact science. I might add, CECL provisions have subject. Okay, let's go through this. Our personal loans are marked at 104% at the quarter end, down 104% at the end of Q4, and well below 105% blended execution achieved in 1.2 billion personal loans. The lower personal loan mark was primarily a function to. You guys can read through this yourself. I just realized that, so you might be reading faster than me. Right, this is what I was talking about the guidance, the revenue always being higher than the guidance. You can see here that every time they post the guidance, the revenue beats it just a little bit. Same for EBITDA and EBITDA guidance, way higher than the guidance. So finally, let's get to the valuation. SOFI has grown up at a 48% CAGR over the last 3 years and is guiding for a 20 to 25% revenue CAGR for the next 25 years, for the next 3 years. So for the next 3 years, it should every year the revenue should go up from 20 to 25%. Let's do a screener for any other banks that have that growth pace would be impossible to see. SOFI is growing just so much higher than any other banks. Okay, so we'll loosen it up to 40% 3-year CAGR and 25% forward CAGR. Here are the results. So no other banks are growing at this pace. SOFI versus AX, one of the competitors. SOFI is just skyrockets above them. And if you look at here, this is in his in his portfolio. The main other holdings are CrowdStrike and Duolingo. There are only three. There are only 3 public SaaS companies that grew revenue 30% last year, and are projected to grow 30% this year, and are currently GAAP profitable. Those are the 2 companies are CrowdStrike and Duolingo. They're cream de la cream of SaaS. So if you put them side by side with SOFI is growing just as fast as these very good SaaS companies that are actually profitable, which means growth like this is very hard to find, and you should pay a premium to buy companies that are growing this fast. Everybody gets all upset with me for focusing on the top line. Here are the net income numbers. So if you look at the net income numbers, SOFI was way down here and now is all the way up there with them. So the management has just been doing a fantastic job with this company and getting it profitable and growing it like crazy. SOFI has the highest growth in income compared to the other companies. I might be wrong, obviously. That's enough of the vlog. Let's go through the investor presentation a little bit. We're just going to look at some graphs. We can see the member growth going nuts, just growing 44% year over year growth. Same thing with the products, just expanding like crazy. Galileo counts. Galileo is a company they acquisitioned in 2020 that gained them exposure to Canada, Mexico, and Colombia. So we're gonna go more down to find that out. And yeah, one thing through their annual statement that I really like to see is that they quote unquote said, "We expect to integrate AI into our technology in the future, especially to improve the experience of our members." As you all know, AI is the future, and any company that mentions AI is going ballistic and just growing like crazy. And this just shows that they're very adaptive and will do whatever it takes to keep up with the competition and be at the top of the market, be at the top of their game. So something else I wrote down from the annual report that they quote, that I'll quote them: "We require a significant investment in maintenance to overcome scrutiny, security, and anti-fraud measures. In addition, we offer fraud and compliance and I wish I could read my own writing, and risk management as a service offering. These types of services are increased recently." So that is one great thing they're doing. Fraud and cyber attacks are growing like crazy and are more and more heard of. And they're taking measures, heavily investing into securement and anti-fraud security, which should make their clients feel a lot safer. And they're making, by insuring their account, and that even if they lose money, they will get it back, makes clients love them. So if you look at the quarterly performance, not bad at all. I beat this up down a little bit from the last quarter, but I believe they can grow easily 20 to 25% for the next 3 years. And then after that, they mentioned, I believe in this blog, if you read through the whole thing, that after that they could not slow down growth, but it go even higher. And if interest rates go down, that is going to be a huge help to them. But now if you look to page 45, there's no page 45 here. I opened the wrong one. Well, that's a mess. The other thing let's just go through this a little bit. SOFI is growing like crazy. It's getting talked about a lot. It's 5 years ago, it IPO'd around $17, went up to $20, and now it's down at $7. And if you look at back then, it was overvalued, absolutely, at $20 when they were making barely $500,000 in revenue and highly unprofitable. They turned their company around and are growing like crazy. And if they continue growing how they are, I believe this company could grow as well, and the share price could skyrocket a little bit, 2x, 3x. Within 10 years, who knows where this will go. These guys are stealing customers from all the big banks and making everything online, which is the future, trading at 1.2 times book value, trading at a price to sales of about 3 times sales. And if you look at the analysts, they project by 2028 average $4.4 billion in revenue and 85 cents earnings per share. So the analysts in Stock and Locker, 17% strong buy. We have 5 buys, 11 holds, and a couple sells. And if you look at insider selling, BlackRock and Vanguard own more than 10% of the company, and insiders hold about 2 to 3%. We have an independent director here with 2%. Insider transactions are not looking very good. You can see the CTO and CEO of Galileo, and even the CEO himself selling some shares. But compared to their full share count, this is not a huge thing, and I believe they're still bullish on the company, even though they aren't buying stocks of it. Who knows what they need this money for? That's about it, guys. I just really wanted to go through that report with you guys and put SoFi on your radars. It has flown off a little bit, but if you look at the chart, I believe it will go back down to $7. I currently do not own any SoFi stock, but when it reaches back down to this gap of $7, I will be opening a position and adding on to it if it stays around $7 or below. Tell me what you guys think. Will this stock fly off and go back to its all-time highs, or will it go back down to its all-time lows?